Picture this. You step into any major bank in New York or London asking for money. What happens next? You're immediately thrown into a world of intense monitoring. They demand everything: your tax documents, social security details, work history, even your fingerprints. Every single penny gets watched. Every move you make gets reported to government authorities. Computer programs measure how risky you are based on rules from the Federal Reserve or Bank of England. This is what we call the light market, the visible, controlled banking world that regular people like you and me use. It's becoming slower and more restricted every day. But here's what most people don't know. There's a completely different financial universe operating right alongside this one. It's hidden in offshore locations and private computer systems. And it's way bigger, faster, more complicated, and far more dangerous. Welcome to the Eurodollar shadow market. Don't let the name fool you. This isn't about euros, and it's not even strictly about dollars. It's a marketplace where dollar-based debts get created outside America by foreign banks. These banks aren't American. Nobody really regulates them. And the assets backing these loans? They're often used over and over again as collateral. Experts estimate this invisible system is worth over $50 trillion. That's more than double what the entire United States economy produces in a year. Here's the scary part. This shadow system is actually what drives the whole global economy. And in 2026, we're facing a terrifying truth. This machine is overheating fast, and nobody on the planet has the power to shut it down. Let me explain how this monster was created. The Eurodollar market wasn't born from crime or greed. It started because of Cold War politics back in the 1950s. The Soviet Union was making dollars by selling oil and other goods. They wanted to keep those dollars safe. But they had a major fear. If they put that money in American banks in New York, the U.S. government might freeze everything. Their solution? They deposited those dollars in British banks in London instead. In that single moment, the Eurodollar was created, the U.S. dollar sitting in a bank outside of U.S. borders. This simple move broke the connection between the currency and the country that created it. A dollar sitting in New York must follow Federal Reserve rules about reserves and interest rates. But a dollar in London, Singapore, or the Cayman Islands? It follows no rules. It's basically a currency without a country. British banks quickly realized something incredible. They could lend out these dollars to companies and governments without keeping reserves at the Fed. They figured out how to create credit from nothing, using the world's most important currency, without needing permission from America's central bank. Jump forward to today, and this loophole has taken over the entire world. Most global business, Chinese factories, Saudi oil sales, Brazilian agriculture isn't financed by U.S. banks anymore. It's all funded through this offshore network. When a French bank gives dollars to a Korean shipbuilding company, that's a Eurodollar deal. The Federal Reserve can't see it. European regulators don't control it. It's a dark ocean of global money flowing invisibly. But here's the fatal problem. These offshore banks can create dollar loans and credit, but they cannot create actual dollar cash or base money. Only the Federal Reserve can print real dollars or create digital reserves to settle these debts. This creates a permanent, deadly mismatch. The world is desperately short on the one thing it actually needs to pay back $50 trillion in debt, real U.S. dollars. The whole system is basically a massive game of musical chairs, with 50 trillion people playing, but only a tiny number of seats available. This mismatch creates what we call the dollar shortage paradox. You'll hear experts claim the dollar is dying because America prints too much money. But in the shadow market, the truth is completely opposite. There aren't enough dollars available. When the global economy slows down, or when prices of assets start falling, these offshore banks freak out. They stop giving out loans. They demand their money back immediately. All of a sudden, the Korean shipbuilder, the Brazilian farmer, and the Turkish government are desperately searching for dollars to pay what they owe. They dump their local money to buy dollars. They sell their gold to get dollars. They even sell U.S. Treasury bonds to grab dollars. This creates a dollar spike, a violent jump in the dollar's value that destroys economies worldwide. This exact scenario played out in 2008. It happened again in March 2020, and right now, It's happening in hidden parts of the repo market. The shadow market is getting a margin call, and it's draining money from the entire planet to survive. The danger gets even worse because of something called rehypothecation. In America's regulated banking system, there are limits on how many times you can use the same collateral. In the shadow market, there are zero limits. One single U.S. Treasury bond might get pledged by a hedge fund to their broker, who then pledges it to a Eurodollar bank, who then pledges it to a pension fund. That one bond is now backing 3 or 4 completely different loans at the same time. It creates a chain of leverage. Everyone feels secure because they see that bond listed on their paperwork. But what happens when one link breaks, when the hedge fund can't pay? The broker, the bank, and the pension fund all reach for that same bond simultaneously. They suddenly discover the collateral was fake. It was owned by everyone, which means it's actually owned by no one. This is what happens when the collateral multiplier collapses. When this occurs, $50 trillion worth of credit can disappear within days, creating a black hole so massive that no government bailout could possibly fill it. Why? Because no government has legal authority to rescue a French bank doing business with a Korean company in London. Government regulators know this monster exists, but they're powerless to control it. The Basel III banking rules were created to make banks safer, but they accidentally made the shadow market more dangerous. By forcing regular banks to keep more money in reserve, they made certain types of lending too expensive for regulated banks. So that business simply moved to non-bank financial intermediaries, MBF is for short. These are hedge funds, private equity companies, and offshore entities that make up the shadow market. These organizations don't take deposits from regular people, so they're not protected by FDIC insurance. They can't access the Fed's emergency lending. They run on hot money, short-term funding that can disappear instantly. Yet somehow, these entities are now the main lenders to corporate America and developing countries. That private credit boom everyone talks about? It's just shadow banking with better marketing. It's $1.7 trillion in loans made by organizations that have never experienced a recession with high interest rates, lending to struggling companies that can only survive if rates stay low. What's more, this market is how China works around the U.S. banking system. China is probably the biggest player in the Eurodollar market. Their government-owned banks borrow and lend enormous amounts of offshore dollars to fund their belt and road projects. This lets them use the dollar's advantages without following America's foreign policy rules, but it also creates a trap. China has a massive debt problem in dollars. Their companies owe trillions in dollar-based debt. This is why China's central bank, the PBOC, is terrified when the dollar's value rises. If the dollar spikes upward, Chinese real estate companies that borrowed in dollars go bankrupt. We witnessed this with Evergrande. It wasn't just a housing crisis. It was a Eurodollar collateral crisis. The damage spread from a construction site in Shenzhen to a shadow bank in the Caymans to a money market fund in Dublin. The invisible connections of this network spread financial viruses instantly, jumping over national borders like they don't exist. The existence of this $50 trillion unregulated monster makes the Federal Reserve's job impossible. The Fed thinks it controls America's money supply. It doesn't, it controls the domestic money supply only. But the global money supply is determined by how much risk these shadow banks want to take. When the Eurodollar banks decide to lend money, global cash flow expands and asset prices climb, no matter what Jerome Powell does. When they decide to pull back, global money dries up and the world slides into recession, even if the Fed drops rates to zero. The tail is controlling the dog. We're living in a reality where U.S. monetary policy is effectively canceled out by the collective panic of a scattered network of offshore accountants. They're the real puppet masters, not because they're smarter, but because nobody can see them. Right now, signals from the Eurodollar futures curve, the specific market that predicts future costs of offshore dollars, are flashing bright red warning signs. The curve is inverted. The system is hoarding collateral. It's refusing new risky deals. The tide is pulling out. We're about to find out exactly which of our supposedly safe institutions have been swimming without clothes in the dark waters of the offshore world. To really understand how unstable this shadow monster is, we need to look deep into the engine room of global finance, the repo market. While the stock market grabs all the headlines, the repo repurchase agreement market is where the real money gets made and lost. Think of it as a global pawn shop for financial elites. In this market, banks, hedge funds, and shadow organizations lend cash to each other overnight, using collateral, usually U.S. Treasury bonds, to secure the deal. It's a $4 trillion daily market that acts like blood flowing through the veins of global capital. If the repo market freezes up, the entire economy has a heart attack within 24 hours. ATMs stop dispensing cash, credit cards get rejected, and trading screens go dark. And right now, the repo market is showing the exact same warning signs that appeared before the 2008 crash and the September 2019 seizure. The gears are grinding because the system's lubricant, high-quality collateral is running out. The crisis in the repo market is being caused by a specific, heavily leveraged gambling strategy called the basis trade. This is the largest accumulation of hidden risk in financial history. Let me break down how it works. Hedge funds, massive shadow organizations like Citadel or Millennium, spot a tiny price difference between the actual U.S. Treasury bond, what you buy right now, and the Treasury futures contract, a promise to buy later. The futures contract often trades slightly above the cash bond. To capture this microscopic profit, literally pennies on the dollar, hedge funds buy the actual bond and sell short the futures contract. Because the profit is so incredibly thin, fractions of a cent, they can't make money using just their own cash. They need to use massive borrowed money. They take the bond they just purchased, use it as collateral in the repo market to borrow cash, and use that borrowed money to buy even more bonds. This creates terrifying fragility. The basis trade only works if two things stay true. First, repo funding stays cheap. Second, bond market swings stay calm. If interest rates suddenly jump, or if price swings explode, maybe from a war or a failed government auction, the margin calls start flying. The repo lenders, the big banks, will look at the hedge funds and say, "The value of your bonds is falling. We need more cash now." The hedge funds, leveraged 50 to 1, don't have that cash. They're forced to dump the bonds to pay the margin requirement. But when they sell $1.5 trillion of bonds into a crashing market, prices fall even further. This triggers additional margin calls. It's a death spiral of disappearing cash. In March 2020, this exact nightmare happened. The basis trade exploded. The most liquid market on planet Earth stopped working completely. There were no buyers at all. The Federal Reserve had to print $3 trillion to buy the bonds and rescue the hedge funds. But today, this position is 3 times bigger than it was in 2020. The Fed knows that if this trade falls apart, the U.S. government will lose its ability to borrow money. The shadow market literally has a gun pointed at the head of the U.S. Treasury, but the risk isn't limited to just Treasury bonds. It has spread like cancer into the corporate world through private credit. After 2008, regulators told banks to stop making risky loans to medium-sized businesses. So the shadow banks jumped in to fill the gap. Private equity firms raised trillions from pension funds and insurance companies to lend money directly to businesses. This market operates in total darkness. There's no stock ticker. There's no daily price shown anywhere. The loans are classified as Level 3, which means marked to model. Basically, the fund manager just guesses what the loan is worth. In our current high interest rate environment from 2024 to 2026, the companies that took these loans are struggling hard to pay the interest. More and more are defaulting. But the shadow banks aren't lowering the stated value of these loans. Instead, they're using payment in kind, PIK schemes, where they lend the struggling company even more money just so it can pay the interest on the old debt. It's a Ponzi scheme dressed up as professional asset management. The real danger here is that you can't access your money. The investors in these private credit funds, including your pension fund, think they can withdraw their cash any time, but they can't. The loans are frozen in place. You can't sell a bad loan to a struggling software company during a crisis. When the recession really hits, the private credit market will lock the exits. Trillions of dollars of supposed wealth will be trapped for 10 years or more. This is the Hotel California of finance. You can check out anytime you like, but you can never actually leave. The political dimension of the shadow market is equally explosive. Because this system runs on eurodollars, offshore dollars, it heavily depends on swap lines from the Federal Reserve. A swap line is a tool where the Fed lends dollars to other central banks, like the European Central Bank or Bank of Japan, so they can rescue their local shadow banks. They demand, "Give me my bond back now." When everyone demands their collateral back at the exact same time, velocity drops to 1. If velocity falls from 3 to 1, then $2 of credit must be destroyed for every $1 of actual collateral. This is a deflationary supernova. It causes a massive shrinking of the money supply that the Fed cannot fix because the Fed prints bank reserves, which stay at banks, not collateral, which moves through the system constantly. The Fed can print money, but it cannot print trust. And the shadow market runs entirely on trust. Regulators are trying to solve this by forcing more trading into central clearinghouses. They want to drag the basis trade out of the shadows and onto regulated exchanges. But this centralization creates a brand new risk concentration. If all the risk sits in one clearinghouse and that clearinghouse collapses, the game is completely over. We're replacing 1,000 small fires with one giant bomb. And shadow banks are nimble and quick. The second regulators touch one area of the market, the money instantly moves to a darker corner, from banks to hedge funds, from hedge funds to family offices, from family offices to DeFi, decentralized finance. The shadow market is capitalism's Wild West. It will always find the frontier where law enforcement can't reach. And right now, that frontier is packed with $50 trillion of borrowed money, sitting on a foundation of reused collateral that's rapidly losing its value. The next crisis won't begin on Wall Street. It will start in a computer room in the Cayman Islands, triggered by a margin call that nobody hears about until the money has already been drained from the entire world. The final destination of all this shadow banking leverage is a single, catastrophic event that financial experts call the Great Freeze. It's the moment when the system becomes so complicated that it can no longer function. In 2008, we experienced a partial freeze. The commercial paper market stopped working and banks refused to lend to each other. But central banks were able to restart it by printing $4 trillion. The crisis building in 2026, driven by a $50 trillion unregulated shadow market, is too enormous for a standard rescue. The Federal Reserve cannot legally lend to a Cayman Islands hedge fund or a Luxembourg special purpose vehicle. When the basis trade collapses or when the private credit market locks everyone out, the Fed will face a simple choice with only two options. Either rewrite the Federal Reserve Act to let them buy absolutely everything, junk bonds, private loans, foreign government debt, or watch the global economy undergo A deflationary collapse that makes the Great Depression look mild by comparison. History tells us they'll choose inflation. They'll choose to buy everything. This will mark the shift from being a lender of last resort to becoming a dealer of last resort. The central bank will effectively take over the shadow market. They'll absorb the toxic garbage onto their balance sheet to prevent collateral velocity from hitting zero. This creates a bizarre situation for investors. Nominal boom but real bust. The stock market might shoot to the moon as the Fed injects $10 trillion to save the system. But the actual buying power of the currency used to purchase those stocks will evaporate. We'll see the Venezuelanization of wealthy country markets. The shadow market's failure essentially forces the official currency to destroy itself to save the unofficial credit structures. This brings us to the most important concept for your personal survival, ICE 9, named by financial analyst James Rickards after a Kurt Vonnegut novel. This describes a scenario where the entire financial system gets locked down to prevent everyone from withdrawing at once. In the shadow market, there's no FDIC insurance protecting you. There's no government guarantee. So when panic erupts, the only tool managers have is gating. They simply turn off the sell button. We saw this with GameStop in 2021 when Robinhood turned off the buy button. We saw it with the London Metal Exchange nickel market in 2022 when they canceled trades. We saw it with Russian stocks in 2022 when they froze foreign owners out. In the coming crisis, money market funds, private credit funds, and even some bond ETFs will probably suspend withdrawals. You'll log into your account and see your money, but you won't be able to touch it. To survive ICE 9, you need to understand the legal pecking order of collateral. In today's financial system, you are not the actual owner of your assets. If you hold stocks in a margin account, your broker has the legal right to lend your shares to short sellers or use them as collateral with shadow banks through rehypothecation. If the broker fails, or if the shadow bank they pledged to fails, your assets become part of the bankruptcy case. You become an unsecured creditor. The secured creditors, megabanks like JP Morgan or Goldman Sachs who lent money to your broker, get paid first. They have super priority status. They will take your Apple stock and your treasury bonds to cover their own losses. This is legally written into the Uniform Commercial Code, UCC. It's the great taking. The system is intentionally designed to sacrifice retail investors like you to save the big institutions. Therefore, your only defense is radical disintermediation, removing all the layers between you and your property. First, direct registration system, DRS. For stocks, this means transferring shares out of your broker's street name and into your actual name on the company's official books through the transfer agent. This removes them from the Depository Trust Company DTC pool. They cannot be lent out. They cannot be rehypothecated. You become the legal owner, not just a beneficial owner. Second, unencumbered title. You need to make sure your home and land are completely free of liens. During a credit crunch, banks can demand immediate repayment of home equity lines of credit, HELOCs, or freeze your access to them completely. If you have variable rate debt, the shadow market crisis will spike your interest rates to punishing levels. The goal is to become anti-fragile, to be in a position where the banking system's collapse does unimpact your everyday life. Third, the shadow hedge. Ironically, the best protection against the shadow market is the asset the shadow market hates most, Bitcoin. Bitcoin is the only asset that is pure outside money, no counterparty risk, but has the liquidity of inside money, can be sent anywhere instantly. The shadow market runs on trust. Bitcoin runs on mathematical verification. When the trust networks of the Eurodollar system shatter, money will rush to the trustless network. We're already watching this happen. In countries with failed banking systems, Lebanon, Nigeria, Argentina, Bitcoin adoption is exploding. The shadow market crisis will bring this same dynamic to Western countries. But, and this is absolutely critical, you must control the private keys yourself. Paper Bitcoin ETFs and futures is just another shadow derivative. It will get locked down just like private credit funds. Only the actual assets stored in your personal hardware wallet is safe from the freeze. Fourth, physical precious metals. We're back to the oldest rule in finance. If you can't physically hold it, you don't actually own it. The shadow market has probably sold the same ounce of gold 100 times over on paper. When the music stops, the 99 people holding paper promises will get a cash payment in worthless currency. Only the one person holding the actual gold bar will preserve their wealth. You want to be the person with the bar. The premium on physical coins will explode. In 2008, paper silver prices crashed, but you could unbuy an actual silver coin for less than a 50% premium over spot price. In 2026, the premium might hit 100% or even 200%. The paper price becomes meaningless. The real street price becomes your reality. The collapse of the $50 trillion shadow market will probably trigger the monetary reset that people have predicted for decades. Government authorities will use the crisis to introduce central bank digital currencies, CBDCs. They'll argue that unregulated shadow banks created this disaster, and we need a transparent government-run system to prevent it from ever happening again. They'll offer to unlock your frozen assets if you convert them into the new digital dollar. It will be forced conversion under pressure. Exchange your locked-up private credit fund for 80 cents on the dollar in FedCoin. Most people, desperate for access to any cash, will accept the deal. This will consolidate the entire financial system into the hands of the central bank, ending private banking as we know it today. It creates a monoculture of money controlled by one entity. The window to escape the shadow market is slamming shut. Right now, the exits are still open. You can sell your ETFs today. You can pull out your cash. You can purchase gold. You can take personal custody of your cryptocurrency. But the shadow market is like a rogue ocean wave. It looks completely calm on the surface until the exact second it crashes down. The warning signals, the inverted yield curve, the repo market spikes, the basis trade leverage are screaming that the wave is building. The $50 trillion ghost machine is running out of fuel. When it stops running, the world stops with it. Don't get caught inside the machine when the gears grind to a complete halt. Step outside the system, own real assets, and watch the paper empire burn from a safe distance.